So, have you ever tried reading financial literature and you suddenly feel like you've been handed a phone book written in a totally foreign language?
Oh, absolutely. It's just a wall of acronyms.
Right. You're staring at all these lists and identical sounding fund names and your eyes just completely glaze over. It feels less like an invitation to build wealth and more like a test you just didn't study for.
Yeah, the financial world definitely has a massive jargon problem. I mean, it creates this huge barrier to entry, which is a shame because it obscures the fact that the underlying mechanics are actually pretty logical once you translate them into, human terms.
And that translation is exactly our mission for this deep dive today. We're looking at a really fascinating approach to financial education, what we're calling a narrative knowledge engine.
Right, which is such a cool concept.
It really is. Instead of a dry textbook, our source material is actually a continuous story. So we're following the student named Aarav, and he's being guided by this wise older mentor. And the mentor uses this vast, mapped out kingdom to explain the totally intricate mechanics of mutual funds.
I love this approach because by embedding the math and all the regulatory rules inside a physical journey, you build the intuition first. You know, you experience the confusion and the discovery right alongside Arav. So the concepts actually stick in your brain.
Exactly. So let's just jump right into this map. Arav and his mentor are standing before this massive territory, and it's surrounded by 5 distinct gates. There's equity, debt, hybrid, solution-oriented, and other steams.
Okay, that's a lot of gates.
Right, but today we're only walking through that first gate. We're heading into the equity kingdom.
This is intense. Yes.
We're going to decode how mutual funds are actually categorized, how to match market cap risk with your personal timeline, and we're going to talk about why the biggest threat to your wealth is probably sitting on the front page of a newspaper.
That's a really important one. But to appreciate how organized the equity kingdom is today, the old man first has to show Arav what the landscape looked like before the rules were written. So he unrolls this older map.
The pre-SEBI map.
Exactly. It represents the historical reality of the Indian market before the regulator really stepped in and cleaned things up.
And this old map is just total chaos. I mean, Aarav is looking at these shops lined up next to each other. One is called the Large Cap Fund. Next door is the Large Cap Opportunity Fund. Down the street is the Large Cap Growth Fund.
They all sound exactly the same.
Right. They sound like they are selling the exact same thing to the investor.
And that was the reality before strict categorizations. Asset management companies, or AMCs, they would launch multiple funds with virtually identical names and, honestly, incredibly similar investment objectives.
It's just the illusion of choice.
Total illusion. It overwhelmed investors with all these options that weren't actually distinct. But the deception went a lot deeper than just redundant names.
Yeah, the mentor tells Aarav that under these old rules, a fund could call itself a large cap fund, which, implies it's investing in massive, stable companies. But secretly, they were packing the portfolio with highly volatile small cap stocks.
Which is incredibly misleading.
But wait, let me push back on that for a second. If I buy a large cap fund, right,
Yeah.
and the manager secretly uses small caps that happen to surge and make me rich, why is that actually a bad thing? Why should I be mad about making more money?
That's a great question, but it's bad because you're judging the manager's performance against the wrong grading rubric.
Okay, what do you mean?
Well, let's break down the mechanics of a benchmark. A benchmark is essentially the standard index that a fund manager is trying to beat. So, say the standard large cap index grows 10% in a given year.
10%, okay.
Right. But the manager of your supposedly large cap fund sneaks in a bunch of highly volatile small cap stocks. And let's say this happened to surge 40% that year.
Oh, I see. So they blend those surging small caps with the regular large caps, and suddenly the overall fund looks like it grew, I don't know, 15%.
Exactly. And you, as the investor, you look at that 15% and you think, wow, this manager's a genius stock picker.
Right.
They beat the 10% average by 5 whole points.
But they didn't really. Mechanically, they just cheated the weightings.
Right. They didn't pick better large companies at all. They just bought riskier small ones.
They completely faked their own skill.
They absolutely did. And the real danger hits when the market turns. Small cap stocks are, notoriously turbulent.
Super volatile.
Yeah. So you bought this fund thinking you were getting the relative stability of large established companies. But because the manager secretly strapped you into a roller coaster just to juice their returns.
To look like a genius.
Exactly. When those small companies crash, and they do, often violently, you suffer the downside of a massive risk that you never consented to taking.
Wow. So the whole comparison is fundamentally broken. So to fix this chaos, Aarav's mentor takes him to a giant building just inside the gates. Above the entrance, it says SEBI, the Securities and Exchange Board of India. And stretching across this massive wall inside the building is an enormous ruler.
I love this visual. This ruler represents the introduction of strict objective boundaries. So instead of an AMC just deciding what large cap means on a whim, the regulator laid down universal definitions based on market capitalization.
Right, and we should probably define that term before we look at the ruler because market capitalization sounds super intimidating.
It does, but it's really not.
Yeah, mechanically, it's just a simple multiplication problem. You take the current price of a single share of stock and you multiply it by the total number of shares that exist for that company.
Just price times shares.
Exactly. It's basically the total price tag of the business if you wanted to buy the whole thing outright today.
And because stock prices change every second, that total price tag is constantly shifting. But regulators needed a way to rank them. So on this giant SEBI ruler, the first section is marked large cap.
And that's just the top dogs, right?
Right, it represents the first to the 100th largest companies in the market, strictly ranked by their full market capitalization.
So literally just the 100 biggest giants.
Yep. Then comes the mid-cap section, which covers the 101st company down to the 250th company.
Okay, 101 to 250.
And finally, the small cap section, which is just everything from the 250th company onwards.
It's incredibly clean geography. Like, there is no ambiguity there.
None. And SEBI didn't stop at just defining the terms. They completely reorganized the marketplace. They restricted companies to offering only one scheme per category, with just a few exceptions like index or thematic funds.
So you can no longer have 5 confusing large cap funds from the exact same company.
Exactly. And furthermore, they mandated monthly portfolio disclosures on the company websites.
Which is huge. That means you, the investor, can actually verify what's inside the fund. It connects the name on the door to the actual portfolio holdings.
It holds them accountable.
Yeah, and this actually brings up a crucial mechanism we have to talk about. The 80% rule.
Oh, this is a big one.
If an AMC runs a large cap fund, at least 80% of that fund's assets legally must be invested in those top 100 large cap stocks.
Which is a brilliant safeguard.
It is. And the way it's described, it really reminds me of a chef's special recipe at a restaurant.
Okay, let's hear the recipe analogy. I like this.
Well, think about it. If I sit down and order a beef stew, logically, the vast majority of the meat in that bowl needs to be beef.
Right.
Let's call it 80%.
Makes sense.
If the chef fills it mostly with chicken, it's not a beef stew anymore, no matter what it says on the menu.
Right, it's chicken soup.
Exactly. The core identity of the dish is protected by that 80% rule. But that remaining 20%, that is the chef's flexible seasoning.
Ah, so that's the fund manager's alpha, the place where they can try to get an edge.
Yes. The manager can hold that 20% in cash if they think the market is about to drop. Or maybe they dabble in a few mid-cap or small-cap stocks just to try and boost the returns.
But because of those mandatory monthly disclosures, you can check the recipe yourself.
You can see exactly what the chef is doing with their 20% seasoning.
That's a great way to think about it.
Yeah.
So Aarav understands the rules of the realm now, and he walks further into the equity district, kind of expecting to find one uniform marketplace.
But it's not uniform at all.
No, the road splits into distinct cities, and they map perfectly to the concept of the risk ladder. The underlying goal in all these cities is wealth creation, obviously, but the mathematical mechanics of how that wealth is generated change drastically depending on where you are.
Right, so let's walk into the first one. Large cap city. Aarav sees these enormous, established, concrete skyscrapers. The mentor points out companies like TCS, Reliance, Infosys, HDFC Bank.
The heavyweights.
Exactly. This city offers lower relative volatility. Now, it's still the stock market, so there are definitely going to be bumps, but you generally have steadier return expectations compared to the rest of the kingdom.
Yeah, investors in large cap city are generally looking for capital appreciation, but with a smoother ride. They want to grow alongside the broader economy without enduring those terrifying stomach-churning drops.
Because these companies have massive moats. I mean, they aren't going to just vanish overnight.
Right, but then Aarav travels further out into mid-cap city. So, again, that's the 101st to 250th companies.
And the vibe changes.
Completely. The buildings are smaller, the construction is rapid, and the streets are just a bit more turbulent. And then beyond that, he reaches the small-cap frontier.
Company 250 onwards.
Yes. And some of these are tiny workshops, some are aggressive startups. The uncertainty out here is just off the charts.
Which begs the question, if this frontier is so wildly unpredictable, why would any sane investor ever put their money out there?
Right. Why take the risk? Well, it all comes down to the fundamental math of growth. Let's look at the runway a company has. If you have a small company worth, say, 1,000 core, which is roughly 120 million US dollars, the runway for it to become a 10,000 core company is entirely plausible.
Because it's small enough to grow that fast.
Exactly. It has the physical and market headroom to multiply its size by 10.
But a mature, established giant back in large cap city, a company already worth hundreds of billions of dollars.
Right. For that behemoth to multiply its size by 10 and become a multi-trillion-dollar company, I mean, that is a monumental, almost mathematically impossible challenge in a short time frame.
This small company just has the math of potential on its side.
It does. But the old mentor makes a really vital distinction here. He tells Aarav, potential isn't certainty.
That is such a key line.
It's huge. Higher expected return does not mean a guaranteed higher return. There's a mechanism at play here called the risk premium.
Let's unpack the mechanics of that premium. Because it's not like small cap funds possess some magical formula that automatically prints more money, right?
Not at all.
Yeah.
It's just that investors are looking at these tiny workshops on the frontier. They're looking at the high failure rates, the lack of historical data, all the wild price swings.
And they're like, nope, not without a reward.
Exactly. Rational investors demand higher returns as mathematical compensation for accepting that terrifying uncertainty. They are essentially demanding a discount on the entry price.
The risk premium.
Yeah, that risk premium is literally the price of admission for the volatility they're about to endure.
You simply don't get the mathematical potential for those massive gains without willingly accepting the pain of the swings.
That's the trade-off.
But nestled between these two extremes, Aarav actually finds a bridge, the large and mid-cap bridge.
Oh, this is a great category. It's a specific hybrid designed for investors who want to step out of the fortified walls of large cap city, but they don't want to move entirely into the frontier.
So how does the bridge work mechanically?
To stand on this bridge, a fund must invest a minimum of 35% in large cap stocks and 35% in mid cap stocks.
Okay, so that's 70% of the portfolio locked into those two specific tiers.
Right.
Which leaves the manager a pretty generous 30% to tilt the balance however they see fit based on market conditions.
Exactly. They could lean heavily into large caps, making it like 65-35 or tilt the other way. It's basically a geographical compromise.
So SEBI's map gives Aarav the geography. It tells him exactly where the cities are and how they are zoned. But knowing where the cities are doesn't protect you from the weather inside them.
And in the equity kingdom, the weather is volatility.
The mentor and Aarav spend some time looking at the environment, and Aarav asks this very innocent question. He asks how to make the turbulent swings stop.
And the old man just tells him the hard truth. You
Yeah.
can't. Volatility is the atmosphere of equity. You can't turn it off.
Let's actually demystify what volatility is mechanically, because I feel like it sounds like this abstract, scary monster to a lot of people.
It does, but it's really not. Volatility is just the daily change in what the crowd is willing to pay for a business.
All right.
Imagine a company that manufactures shoes. On Monday, they make great shoes, their factories are running smoothly, their debt is low. On Friday, they were making the exact same great shoes. The underlying business is identical.
But maybe on Wednesday, some macroeconomic report comes out, inflation ticks up, and the global crane gets anxious.
Yep, the sentiment shifts.
And suddenly, the price of that shoe company's stock drops 5%. The business didn't change at all. The crowd's sentiment did.
And that sentiment swing is exactly why timelines are so critical. So Aarav and his mentor, they walk past a sign for a 2-year holding period.
Oh, right.
And the mentor explains that if you need your money in 2 or 3 years for a specific non-negotiable goal, say a down payment on a house or paying for college tuition, putting that money into equity is a mathematical disaster.
Because the stock market absolutely does not care about your personal closing date.
It really doesn't.
If you have a strict 2-year horizon, crowd sentiment might be highly negative at the exact moment you are forced to liquidate.
Right. You are forced to sell a perfectly good shoe company at a 20% discount just because it happened to be a bad week for the broader market.
So what's the solution?
The required mechanism to survive volatility is just time. Approaching equity requires a long-term mindset, often 10 years or more.
But time doesn't magically guarantee a specific return, right?
No, of course not. What time does is give your investment the breathing room to live through multiple cycles of crowd panic and crowd euphoria. You ride out the irrational drops so you can capture the eventual fundamental recoveries.
Having a long-term mindset sounds incredibly simple until you are actually surrounded by the noise of the market.
Oh, it's so hard in
Yes,
practice.
yeah. As they walk further, Aarav sees this man trapped in a maze of doors. Every door is a different mutual fund, and this guy is frantic.
He's sprinting around.
Literally. He looks at Fund A, sees it dip slightly this month, yells, "It's not performing," and immediately jumps to Fund B. Then Fund C has a good week, so he liquidates and jumps to Fund C. He is treating mutual funds like a casino.
He's suffering from the illusion of control. By constantly switching redeeming units from one fund, paying the exit loads, paying the taxes, and buying another, he feels like he is actively managing his wealth.
Yeah, mechanically.
Mechanically, he is doing the exact opposite. He's usually selling something after it has already dropped and buying something else after it's already peaked.
He's buying high and selling low over and over again, systematically destroying the mathematical engine of compounding.
Exactly. He's confusing frantic movement with actual progress.
Which brings us to the climax of Aarav's lesson for the day. At the end of this frantic maze stands a newspaper seller, and the front page is just screaming in massive bold letters, "Markets may fall."
A headline every single investor has seen 100 times.
I swear I saw it yesterday. People in the street are panicking and liquidating their portfolios based on this newspaper. And Aarav asks his mentor, shouldn't they protect their money? And the old man sighs. He tells Aarav this deeply personal confession.
This was a powerful moment in this story.
It really was. Back in 2007, the mentor was invested in a perfectly good, fundamentally strong mutual fund. But he read a terrifying newspaper headline predicting a massive crash.
Yet he panicked.
He let fear hijack his logic, and he exited the fund completely.
And the true tragedy of his mistake wasn't necessarily that the market dipped afterward.
No.
The tragedy was the mechanical break in his timeline. By letting the headlines scare him out of the market entirely, he stopped his compounding journey cold. And he never reinvested when the market eventually recovered and went on to hit record highs over the next decade.
He allowed short-term noise to dictate a long-term plan. I mean, think about your own retirement account or, your brokerage app. How many times have you checked your balance during a week of bad macroeconomic news and felt that visceral urge to just hit the sell button and run to cash?
It's a very human reaction.
It is. But Aarav realizes how profound this psychological trap is, and he writes a single rule in his notebook. A headline is information. It is not automatically a reason to abandon a long-term plan.
That realization right there is the cornerstone of surviving the equity kingdom. Volatility feeds on your emotional reactions to headlines. If you can mechanically decouple your 10-year strategy from today's front page, you disarm the trap entirely.
So let's synthesize what Aarav and hopefully all of us have mapped out today. He started his broader journey learning about the mechanics of inflation and why money actually needs to grow.
Right.
He learned how mutual funds pool money together to achieve scale. And today, he navigated the actual gates of the equity kingdom.
He now understands the objective boundaries of the SEBI ruler, the large cap, mid cap, and small cap definitions.
The geography.
Exactly. He grasps the mechanics of the risk ladder, knowing that higher potential returns mathematically demand the toll of higher volatility. And he understands that time is the only structural shield against that volatility.
He knows what the cities are, and he knows how to survive the weather. But of course, the mentor leaves him with a cliffhanger.
Always a cliffhanger.
Aarav feels fully equipped, right? He turns to the old man and says, okay, I know the categories, I know the rules. Which specific large cap fund should I buy? And the old man just closes his book and says, not today.
Because knowing the category is only step one. It's just picking the city you want to live in on the map. Tomorrow, Aarav has to learn how to evaluate the specific house on the street.
Which is way more complicated.
Oh, absolutely. Comparing expense ratios, evaluating historical risk metrics, looking at the fund manager's track record, that is a whole different layer of the matrix. You have to understand the universe, then the category, before you ever evaluate the specific fund.
It's a vital progression, and it builds the foundation so you actually know what you own and why you own it. But as we wrap up this deep dive, I want to leave you with a provocative thought.
Let's hear it.
Something that builds directly on the rigid rules we just explored. We talked heavily about SEBI's giant ruler, and it brilliantly fixed the chaos of the old, messy map.
Oh, for sure.
The top 100 companies are large cap. The 101st company is mid cap. It's clean and it's objective.
It creates order out of total confusion.
But think about the invisible incentives a strict boundary like that creates. If a large cap mutual fund legally has to pump 80% of its billions of dollars into those top 100 companies, being inside that top 100 is a golden ticket for a corporation.
The financial gravity of that boundary line is immense.
So imagine you are the CEO of the 102nd largest company in the market.
Okay.
You are officially a mid-cap. You are exactly 2 spots away from crossing that magical 100th boundary and unlocking a tsunami of mandatory automated investment money from large-cap index funds and mutual funds.
Oh, wow. Yeah.
What happens at that border? Do companies start artificially inflating their stock prices? Do they engage in drastic, perhaps even reckless corporate actions just to temporarily spike their valuation right before the regulators measure the market caps for the next cycle?
It is a fascinating paradox because in the process of building a rigid wall to protect the investor from confusion, you inherently incentivize the companies themselves to find creative, potentially dangerous ways to climb over it.
Exactly. Does creating a perfectly clean rulebook accidentally create an entirely new game of manipulation right at the edges? It's something to mull over the next time you look at the top holdings of a mutual fund and see who just barely made the cut.
It really makes you think.
Thank you for joining us on this deep dive into the equity kingdom. And remember, the next time financial literature feels like a phone book in a foreign language, maybe you just need the right map. Until next time.